Good evening. Thanks for joining us at tonight's presentation. Tonight I'll be covering a fair few things regarding self-managed super fund and also buying direct property inside of your super. Tonight's presentation, I'm the only presenter. My name is Justin Beaton. I'm from Sequoia Superannuation. Sequoia Superannuation is a leading Australian self-managed super fund property expert. We also have teamed up with Positive Real Estate. Our expertise is in self-managed super fund. Their expertise is in sourcing property specific for superannuation. And I'll go through tonight the pros and the cons, and also what makes and constitutes a good property inside of super, and those that don't so much. So tonight, look, it's only general advice. It's only information. It's obviously haven't considered your personal investment circumstances. There's also a few case studies and examples. Now, I've made a few assumptions in those case studies. I think the easiest way to learn as a person is to go through a person of a similar situation and see what they can do, and hopefully apply one or two of the strategies that we're going to be talking about tonight. My goal tonight over the next hour and a half is to give you a few gold nuggets, something to learn, to write down. If you can take 2 or 3 things out of tonight's presentation, then I think I've fulfilled my goal, and hopefully you have in taking this hour and a half out of your busy schedule to tune in. Look, I do respect and applaud each and every one of you for taking time out of your busy schedule to educate yourself, because education is very powerful, but it only becomes powerful when it's applied. So following on from the presentation tonight, or this webinar, you'll have the opportunity to organise a one-on-one meeting with a Sequoia and Positive Real Estate expert, just to do a complete health check on your current superannuation portfolio. That's free of charge. We'll do it for nothing. So there's no sell or anything like that. Tonight is purely about education, which is great. The problem I see inside of self-managed super funds, or super in general, is that the majority of people don't know you can actually go out and buy direct residential property inside of your super fund. So it's good you're about to be educated in the benefits and the strategies involved around that. So good work. A bit about me. I've written a few superannuation books. I've written Making Super Sexy 2 editions, basically one on how you can gain exposure to shares, which is my core expertise, and also superannuation. And it's more so in the last 5 years that I've taken superannuation seriously. You go back 5 years ago, superannuation for me as an individual was the distant memory. I didn't really take superannuation serious, because it's going to be 30 years before I can access it, or somewhat, maybe even longer. However, 5 years ago, I realised that the earlier I start taking super seriously, the more money I'm going to have in retirement to live a life of abundance. Now, for me, living a life of abundance is basically to have the option to do what I want when I want, whether it's playing golf, fishing, spending time with my kids, or by that time my grandkids, travelling the world with my wife, just enjoying my later years. Whether that happens at 65 or 95, I'm not too sure, because I actually like working at the moment, because I actually do what I'm passionate in. So Making Super Sexy, they're not my legs, just so you know. Look, super for me, it really turns me on. I find super extremely sexy. So when I say super sexy, look, hopefully tonight with a few gold nuggets that I can give you, you too will believe super is phenomenal. The other book I've written is The JB Way, which many of you may have read. If you want a copy of one of these books, the last one on Making Super Sexy, which has just been launched, is how you can grow a multi-million-dollar property portfolio using your super. So by all means, if you want any of those books, just email me and I'll send you a copy free of charge. We don't charge for education. We basically give it away for nothing. We want to educate investors so you can make an informed investment decision when it comes to superannuation. We're not financial planners. We're not going to sit down and go through your personal financial situation. Rather than charging 5 or 10 grand for a plan, of which the majority of the stuff you get in that sort of thing you know already, would rather you put that 5 or 10 grand into investments. And our job is to educate you around that. Now, at the moment, it's unfortunate because the majority of people are working extremely hard. Like we earn income. The first person that gets paid out of that income is not you. It is, in fact, the ATO. Australian Tax Office is taking around 37% of everyone's income on average, up to 46.5% for some of us. So we're paying taxes, then we've got superannuation. 9% of our salary is going into super, and by 2020 that's going to be 12%. Then there's mortgage that we've got to pay. 40 to 60% of the majority of people's income is going into paying their mortgage. Then credit card, then obviously feeding the family. And when you go through all those expenses, we're left with bugger all pretty much for wealth creation strategies to save for retirement. Now this is the rat race that people do day in, day out. And there's nothing wrong with this rat race. The issue is, though, it's probably not going to get you to financial freedom in retirement. Financial freedom in retirement, if you look here in a recent report, out of 100 people, 15 of them actually won't make the age of 65. So 15 out of 65 are actually going to die before they reach the retirement age. 74 will be dependent on welfare or the pension. 7 must work to survive. 3 may be financially secure, and 1 wealthy. So it's only a small percentage of the population that are actually going to reach their investment and financial goals for retirement, simply because of this rat race. Now, it's a good thing that you've tuned in, because the earlier you start the process of saving for retirement, the more money you're going to have to enjoy once you reach it. Now, the total superannuation assets, when you look at the average Australian between 55 and 64, those people fast approaching retirement, is for a lady 54 grand for pink, and for blue $113,000. So that's the average super fund. So it's not too good out there. One of the main reasons that's the case is that for the majority of people of 55 to 64, compulsory superannuation was only introduced in the early 90s, so they haven't had a long period of time, or over 2 decades, to accumulate enough money in superannuation. But for a lot of us, when we reach retirement, that should be our largest asset, superannuation. If you look at superannuation, it's interesting because you look at industry and retail super funds, they're out there promoting themselves as being the good guys. That if you remember the commercials, there's 2 escalators that go up. One escalator is for an industry super fund. The same sort of person in a retail super fund ends up with a lot less, simply because of the fees. Well, that's what they say. However, if you look at the top 20 private companies, we can look down the list and see many superannuation entities. Australian Super, one of the largest industry super funds, total revenue $7.5 billion. So they're taking $7.5 billion worth of fees, and so-called doing it to save the investor money. First State Super, $6.2 billion. Uni Super, $3.6. Health Employees Superannuation Trust, $3.3 billion. So this is their revenue. Sun Super, $3.2. Retail Employees Superannuation Trust. Host Plus Super, Vic Super. So if you look through the top 20, there's over 50% of them are actually superannuation entities. So at the moment we've got around $1.4 trillion in the total superannuation pool here in Australia. If you look at these people, there's a lot of that money that's going to fees. But let's look at it. I'm happy to pay a person if they provide value. Let's look at the performance they've provided. Last 10 years to June 2011, the average rate of return for large super funds was 3.8% per annum. 3.8%. So if you take into consideration the inflation, which is slightly below 3, the actual real rate of return is bugger all. I'm not too sure about you, but industry or retail super funds that are providing me close enough to a 1% return after inflation are not achieving my retirement goals. In fact, if you look at what they are achieving is taking a huge amount in fees. So it's not really servicing me too much. So if we look at the retirement statistics, if we're looking at superannuation, yeah, look, the pool isn't that high, but the alternative isn't that glamorous either. The alternative is to rely on the pension. Look, the pension at the moment, if you're an individual, is $306 per week. Now, if you're a couple, so you've met your lifetime partner, you've stayed together for your entire life, you actually get less than $306 each. You have $522 each. As a couple when combined. So it's about $270. So you stay together and you get less. You would get more if you were actually classified as individuals. Now, at the moment, the entitlement age to the pension is 65. However, in a few years' time, it'll be 67. That's right. The government has passed legislation which proposes that the entitlement age to the pension is going to be increased from 65 to 67. Now, I'd imagine that set the precedent for many future governments to continue the trend and continually lifting the bar for the pension. After all, they have to. Look, if we all retired and relied on the pension, then economic consequences for the economy would be dire. With the baby boomers fast approaching retirement, there's almost more people that would be in retirement than working. If we all relied on the pension, look, it would be catastrophic for the overall economy. So it's a good thing the government introduced compulsory superannuation a few decades ago, because it has forced us to be disciplined, patient investors. So near into 2020, like I remember, you go back a few years ago now, maybe I am showing my age, but I remember back in the 80s and the early 90s, there was a TV show on telly called Beyond 2000. I'd imagine a majority of you actually watched the show. But Beyond 2000 seemed like it was going to be an eternity away. Like I'm sure they had on Beyond 2000 iPhones or the internet, how quick information is, or maybe not altogether, really. It is amazing what has happened in such a short period of time when it comes to technology. However, the new Beyond 2000 has become Beyond 2020. Now, some people are suggesting the speed of travel would mean that you can fly from Australia to London in 2 or 3 hours. Now, that's a possibility. I'm not too sure if they can actually achieve that. But let's talk about facts. What will occur by 2020? Not possibilities like air travel, but actual facts. What does the future hold? As fact, by the year 2020, you will need to be 67 to be entitled to the age pension, as I just mentioned. It is fact that the proportion of people aged over 65 is expected to nearly double with the baby boomers fast approaching retirement, and the fact we're living longer. It is fact by the year 2020 there will be over $3 trillion in superannuation. That's an interesting number. Remember that number, $3 trillion. I'll come to that in a moment. $3 trillion will be in superannuation by the time we get to 2020. Now it is currently $1.4 trillion. So it's going to double in the next 8 years. It is fact that by 2020, the superannuation guarantee, this is the compulsory superannuation contributions your employer needs to make, will increase from 9% to 12%. It'll be 12% by 2020. So when 12% of our income is going into superannuation, look, you've got to start taking it seriously. Look, if 9% wasn't enough, look, this is our hard-earned cash. You're working hard for those contributions. You need to start ensuring that the money inside of superannuation is invested in the most appropriate asset class. So year 2020, 2007, the Treasury undertook a few important forecasts. Now that was the $3 trillion superannuation mark. So they expect $3 trillion to be in superannuation. However, they only estimate the total valuation of the Australian share market, if you add up every company listed on the share market, market's market capitalisation. As a whole, if you add them all up, the entire market capitalisation of the entire ASX is estimated at being only $2 trillion. Now, the majority of Australian superannuation is invested in Australian shares. Now, let's assume all of it is. We've got $1 trillion left over. So the Treasury, in their forecast, predicted that we're going to run out of investments. Even if the superannuation industry owned every share listed, no one owned a share directly or no one internationally owned an Australian share, we would still run out of investments. There would be $1 trillion shortfall. So that the Treasury thought, well, what's everyone going to do with that $1 trillion? Then they also undertook a study as to how people that have become self-funded, how actually they achieve that. Now, the majority of self-funded retirees that still exist actually haven't become self-funded retirees through superannuation. What they've done is accumulated their wealth inside of property. My parents, grandparents, how they developed their wealth to fund their retirement was simply they worked hard, they bought a house. To buy that house, they borrowed money through a mortgage, and then they paid it off over a 25-year period, 30-year period, and then they retired. They retired. They didn't need the big house anymore, so they downsized. They sold the house, bought a smaller apartment with less money, and used the equity that they had accumulated to fund their lifestyle through retirement. So the Treasury thought, well, you know what? Majority of people have become self-funded retirees through property. Why aren't people investing in direct residential property inside of their superannuation, was the question they posed. Well, simply the restrictions back in 2007 meant to buy a property, you had to fund it 100% with cash. That is, you weren't able to borrow. Now, I'm not too sure about you, but the first house I bought, the first house my mum purchased, was using debt. Sure, there was an equity component, but we borrowed the majority of the money to go out and buy that property. So the restrictions pre-2007 meant to go buy a property, you had to fund the entire amount. So if a property was worth 400 grand, you needed to have a superannuation balance of $400,000 to go buy that property. If you did just buy that one property, you'd be 100% exposed to one asset. So the risk of your super fund falling would be high. So the government looked at it and thought, you know what, the majority of people are becoming self-funded retirees by buying property. And the only way they're gaining access to property is because they're using borrowed funds. So the ATO and the government passed legislation in September 2007 that allowed self-managed super funds the right to borrow and leverage into both residential and commercial property for investment purposes. Now that was in 2007. In 2010, the rules were clarified around what the borrowing arrangements meant. For a borrowing arrangement to be entered into inside a superannuation, the loan needs to be provided in what's called a limited recourse basis. Now that's very important. What the government wanted to ensure didn't happen in the future was that a self-managed super fund went broke, in that they owed someone more money than the assets they held. So the limited recourse provisions of the loan meant that, or means now, if you buy a property worth $500,000, for instance, you contribute 100 grand and borrow the additional 400. So you've got an 80% LVR. So you've borrowed 80% of the property value. What the limited recourse provisions means is if that property value drops by 50%, let's be pessimistic, let's say it goes down completely 50%. So your asset, the property, is now worth only 250 grand. Now this poses a problem because you have a $400,000 loan on that property. By having the $400,000 loan on the property inside a superannuation, and what the limited recourse provisions of the loan means is that the bank has no recourse on the super fund or on you as an individual, unless of course a personal guarantee is provided. So the 150 grand shortfall between the 400 grand loan and the $250,000 property, in that instance, is the bank's risk. Sure, you've lost your 100 grand being your equity contribution, but the bank has no recourse back to you as an individual or your super fund for any other assets, unless, of course, you provide a personal guarantee, which many banks do provide. But the good thing in 2007, by allowing us to borrow inside a superannuation under a limited recourse provision, loans, meant that we could now gain access to property and also borrow money to fund the majority of the purchase. Now the banks will lend up to 70% to buy a commercial property and up to 80% to buy residential property. So the rules have meant that to go out and buy a $500,000 property, your contribution only needs to be 100 grand. For a 300 grand property, your contribution needs to be at least 60 grand. So it gives us the capacity, even with small superannuation balances, to go and gain access to individual investment, residential property and commercial property. Current state of play. In 2011-2012, because of the relaxing of the rules, predominantly because of around property and lending, there was 35,000 new self-managed super funds set up. Now, a self-managed super fund, you can have up to 4 members. So around about 100,000 people established new funds in that financial year alone. Self-managed super funds now have assets of over 30% of the total superannuation pool, $429 billion. So over 30% of the Australian population now are managing their money through a self-managed super fund. Now, I believe one of the main reasons is that they realise with a little bit of education, they can gain a better return than what the so-called professionals that are managing their money in industry and retail super funds that we mentioned before. After all, what the 10-year rate of return, what was it again? Around 3.8%. Now, 3.8% isn't a huge return. You can have your money in your bank account and that would return you a little bit more than 3.8%, I would have thought. Self-managed super funds account for more super than any other sector. Over 30% of the total superannuation pool is in self-managed super funds. So it's been a fast-growing sector as more and more people want to take control of their superannuation assets. Because after all, super is your money. You should be investing your money inside a super just as you are outside of it, provided it's within the superannuation guidelines in that it needs to meet the sole purpose test. That is, Superannuation needs to be for the sole purpose of providing an income in retirement. A recent survey conducted by Smart Property Investment Magazine revealed that 72% of the respondents plan to switch to an SMSF in the near future. 72%. Now, I think one of the main reasons people don't go into a self-managed super fund is because of the myth that they don't have enough money to justify setting up a self-managed super fund. Well, today, with a mini SMSF that Sequoia Superannuation have created, if you do have a combined superannuation balance, this is when you're combining it with family members. You can have up to 4 members. So your wife, your brother, your sister, your husband, you can pull all your superannuation together. With a mini SMSF, if you combine it all together and you've got 50 grand, then you should have enough to at least cover the cost of the self-managed super fund and ongoing investments. When I say cost, the cost to switch to an SMSF should be very similar to what you're paying now. I'll go through those details later on. 92% of those said that they would borrow to invest in direct property inside of their SMSF. So what I'm talking about tonight, look, this isn't a whiz-bang, fancy, new age investment philosophy. What I'm talking about tonight is just teaching you the way the majority of people over the last 50 to 100 years have funded their retirement. This is the old-fashioned way, to buy property and to live off it in retirement, the income that you can generate from those properties. So this isn't rocket science. It's just the old-fashioned way people have accumulated their money to fund their retirement. So let's look at the 4 benefits of direct property inside of superannuation. Now, these are the gold nuggets that I'm talking about, and this is pretty sexy stuff. Now, you generally find when people are passionate about something, they're going to inundate you with information, and tonight I'm going to inundate you with information. I'm going to give you as much information as possible. So don't be worried if you don't take it all in, because after this, look, I can send you a copy of my book, which all the strategies are outlined in detail, and you'll also have that opportunity for a one-on-one meeting with a investment manager, and that's free of charge. It's complimentary. So as I said, our job is to educate you and empower you to make the right, best decision for you and your family. So let's look at superannuation. Let's look at these golden nuggets. 4 reasons why to buy a property using your super versus outside of super. 1, to reduce the real cost of an investment property by up to 40%. That's phenomenal. I know initially when I purchased my properties, look, you call up the people, the real estate agent, and when you know you want to buy it, you start negotiating, right? If the property was for sale for 400 grand, you're just not going to write out a check for $400,000. You're going to start trying to cut them down a bit. So your first offer might be $350,000, for instance, and you may end up buying it for $375,000. So you spend 3 or 4 days or sometimes weeks negotiating 10, 20, 30 grand off the purchase price if you're lucky. Well, just by choosing the right investment vehicle, you can also save an additional 40% on the real cost of that property. Now, I want to go through why. That's choosing superannuation as opposed to your own name. Now, when I go through this, it's important to understand a key difference between price and cost. Now, go back to year 11 economics. Like, I was a bit of a rebel at high school. When I say a rebel, I spent a lot of time on sports fields as opposed to in classrooms. And my economics teacher pulled me aside in year 11 and said, look, it's really frustrating trying to teach you guys. Look, you're obviously gifted. You don't need to spend too much time studying, and you do pretty well in exams. However, look, Justin, I just want you to learn one thing. If you can take away one thing from the entire year of economics, this is it. And he taught me the difference between price and cost. Now, price and cost, what's the difference between price and cost? Well, let's look at it. Now, if I go down I take my wife to the local Thai restaurant with my kids. We have an entree, a few mains, a bottle of wine. Let's assume the price of the meal comes to $100. That's the price. The price of the meal is $100. But what's it cost me? What do I need to earn before tax to end up with $100 in my back pocket to pay that dinner? So what the price is the after-tax amount. What the cost is the before-tax amount. So that $100 meal, if we buy it outside of super, the price is $100. Because that's what it's going to cost me after tax. Before tax, though, if I'm in the highest marginal tax bracket, while the price is $100, the actual cost is $187.50. That's how much. $187.50 is what I need to earn to have $100 in my back pocket. So while the price is $100, it's cost me $185.50. Now let's look at superannuation. If I was able to buy that dinner, and it's the same thing if we're talking about the purchase price of dinner or an investment, or in this case property, but let's just assume it's $100 example. The price is $100. But because of the tax rate inside of superannuation, the cost isn't $187.50. The cost is $118. So after all, one of the greatest benefits of superannuation is the tax rate. The tax rate inside of superannuation is phenomenal. It is a tax paradise. So while as an individual we're paying up to 46.5% in tax currently, the tax rate inside of superannuation is 15% for the majority of us for income that we put into superannuation and income earned inside of your super fund. So it's a maximum of 15% for the majority of us. As of the 1st of July 2012, if you earn less than $37,000, the effective tax rate for contributions made into superannuation, concessional contributions, is 0. What that means is, why that's come about is that the government introduced the low income tax rebate for superannuation for those that earn less than 37 grand. That is, the 15% that's normally applied for contributions tax is rebated back to an individual up to $500, which means if you earn less than 37 grand, the effective tax rate for contributions made into superannuation, concessional contributions, is 0. So it's 0 if you earn less than 37 grand, the effective tax rate. If you earn above 37 and less than 300 grand, it's 15%. As of the 1st of July, the government also introduced rules that if you earn over 300 grand, the tax rate on contributions is 30%. Now that's where in accumulation phase. Where it gets very sexy is once you retire. Once you retire, on any income earned inside your superannuation, the tax rate is 0. Tax-free. Tax-free paradise. Legal, tax-free. Like you can earn $1 million inside of superannuation as income, and the tax rate is 0. You pay no tax. Had you earned $1 million in your own name, you're probably going to pay around $400,000 in total in tax. This is why it's so sexy. It is phenomenal. Now, capital gains tax, if you're in accumulation phase, which means while you're working and below the age of 55 currently, probably closer to 60 for the majority of you, depending on your preservation age. Now, while you're in the accumulation phase, capital gains tax is 15% if you sell the asset within 12 months. If you hold the asset for longer than 12 months, the effective tax rate is 10%. Now, again, once you get to retirement, so look, well, you can buy a property now. Buy a property now, and once you get to retirement, over the age of 60, start drawing an income from your superannuation. The tax rate, if you sell that property at that time, is 0. Tax-free. You pay no capital gains tax on assets sold once you're in retirement phase and drawing income off your superannuation. So from a tax perspective, superannuation is phenomenal. It is a tax paradise. So when we're looking at price versus cost, the price is after tax, the cost is before tax. By simply buying an asset using your super where the tax rate is lower, 15%, you're reducing the real cost of buying a property by up to 40%. In fact, the real cost outside of superannuation is up to 58% more expensive if you're buying it outside of super. So let's look at an example. Let's look at property. Sam's 50 and Jason's 50. Sam and Jason are married. Sam, she's earning 40 grand per annum and has 60K in super. Jason earns 180 grand, working as an engineer, and has $80,000 in super at the age of 50. So they're typical Australians and haven't taken superannuation seriously. But Sam wakes Jason up every morning after looking at Koshi on TV and said, Jason, we've got to start planning for retirement. Retirement is only 15 years away at 65, and they wouldn't mind retiring early. So we'll start taking investing serious. And she's looking through the local newspaper, and she sees a property she wants to purchase. Says, come on, Jason, we've got to go buy a property. We've got to get our money working harder for us, which I'm sure many of you have heard the story before. So Sam and Jason both own their home. It's worth about 600 grand, and they have a debt of $300,000 on that property. They're paying it down in principal and interest, which is the textbook way of accumulating wealth through property. All right, now they're going to go out and buy their first investment property. But Jason says to Sam, I know you want to buy that property, but let's go speak to the accountant. We're to go get tax advice to ensure we're buying it in the right entity. So they rock off to their local accountant, and they go, look, we're wanting to buy an investment property. The accountant sits them down and says, Jason, because of your high income, you will get the greatest tax benefit on the interest expense because the property is negatively geared. So what we need to do is buy it in your name because of the tax benefits you're going to gain from owning the property. It's a brand new property. They're getting told a depreciation, which is a great tax deduction in that, look, it's a tax deduction, but it's not a cash flow cost, which is phenomenal. But what I've learnt is that what the ATO give, they take back. So what happens when the ATO is assessing the capital gains when they sell the property is they reduce the cost base of the property. So they've got 300 grand equity and they want to go buy the investment property using that. So buy a property worth 500 grand. Property is sold in 10 years' time when they're both 60 for $1 million. So let's look at the options, the accountant way or Sequoia superannuation, or our way, which is buying the property utilising their super fund as opposed to in Jason's name, which a majority of accountants would probably look at recommending. So they'll be 60 when the property is sold. Strategy one, negatively geared. Let's purchase outside of super and purchase in Jason's name because of the greater tax benefits you're going to receive along the way. Strategy two, super. We're going to use their super fund. We're going to borrow some of the money to fund the purchase because they don't have 500 grand, so we're going to borrow 80% and utilise superannuation to buy the investment property. So let's look at price versus cost. First and foremost, to pay for the deposit, to accumulate the deposit, it's done in after-tax dollars. So if we're accumulating 140 grand for the deposit, which is this number here, 140 grand, for them to accumulate that deposit, Jason needs to earn $261,000, $682. So while the price is 140, the cost outside of superannuation in Jason's name is $261,682. Now, if we look inside of superannuation, as you can see, the deposit is the same. However, to accumulate 140 grand, to have that in cash to pay for the deposit, because of the lower tax rate inside of superannuation being 15% for Jason, he only needs to earn 164 grand. So if you look at this, the real cost of the property is a lot less inside of their self-managed super fund than it is outside of their super fund in Jason's name. They're almost $100,000 better off simply by buying it inside of their super fund as opposed to outside of it when we look at price versus cost. You see why I'm so excited about this? Look, the majority hurdle of many people to go buy an investment property is simply because they can't accumulate the deposit. Because that rat race I spoke about before. After you pay taxes, superannuation, you pay for your mortgage, you pay for credit card debt, you start putting food on the family, you pay for your car. Look, we're left with very little to save for wealth or to fund a deposit. But inside of superannuation, simply because of the tax benefit, you've got a lot better chance of accumulating the money. In fact, for Jason and Sam, they've got that money sitting there. So in 10 years' time, they sell the property. Now, if they bought the property in Jason's name, let's look at how much capital gains tax they would pay. So the property cost base was 520 grand. So it's $500,000 plus stamp duty, transaction costs, legal costs, all that sort of stuff. Okay. They had the 50 grand in depreciation I talked about. So I know it's a good cash flow deduction in that it's a tax deduction and a tax benefit where it hasn't cost you any money, but what the ATO give, they take back generally. So while they've given it to you along the way, when they're assessing the capital gains tax liability, they actually take off the 50 grand from the 520,000 to determine what your cost base was for tax purposes. So when calculating your capital gain, it's $1 million minus the 470 grand purchase price, which means that you've made a $530,000 tax profit. Now, because Jason in his own name held the property for longer than 12 months, because he held it for 10 years, he's entitled to the 50% capital gains tax exemption, in that 50% of the capital gains is exempt from tax, which means $265,000 is assessable, and that gets added on to his normal marginal income. The total tax he pays is $123,225 on that property sale, which is a good result. But we've made 500 grand profit, and they pay $123,000 tax, which isn't a huge amount when you consider the overall circumstances. However, if Jason had purchased and Sam had purchased that using superannuation, let's look at what the capital gains tax liability would be if they sold the property. Now everything still exists, the same thing. We're selling it for $1 million. The cost base was $520. You've enjoyed the depreciation allowances. You can still claim all the same deductions in super as you can in your own name for owning a property. So we get the benefit of the depreciation, excuse me, over the 10-year period. Now, the capital gains tax inside of superannuation. So remember, Sam and Jason are now 60. They're 60 years of age. They've retired and started to draw an income from their superannuation, which means when they sell the property, after they elect to draw income off their super and met their preservation age being 60, the capital gains tax is zero. They pay no capital gains tax on the entire gain. So even though they buy the property now, sell it in 10 years' time, the property's up $500,000, they're paying no capital gains tax. Why? Well, the current superannuation laws allow us to commence a pension at that time. When you elect to draw a pension out of your super fund, all underlying assets supporting that income stream are tax-free. In fact, if they didn't sell the property and just decided to live off the rental income, all income from that rent, all that rental income is entirely tax-free as well. As I said, you know, up to $1 million, even more inside of superannuation as income, and it's completely tax-free. It is a tax paradise. So you look at the difference, the overall benefit. If we look at the deposit, the cost, look, it's almost $100,000 better off by choosing super when we compare our costs, even though the price or the deposit's the same. That's after tax. And also the capital gains tax is there at 123 grand. If you bought it in Jason's name, inside of super is zero. So the overall advantage of buying inside their SMSF as opposed to in Jason's name is $220,000 over the entire period. So a phenomenal difference. 220 grand more in your back pocket than you would otherwise had you followed the accountant's advice and purchased that property in your own name, or in Jason's name in this case. So phenomenal. Hopefully that's a nugget that you can take home. How to reduce the real cost of a property by up to 40%. Have a lot more money in your back pocket by the end of the time. So the real cost of the deposit is $96,000 less using super. You're 123 grand better off from capital gains tax because the entire capital gains tax liability has been mitigated because of superannuation. So first, we're going to reduce the real cost of an investment property by up to 40%. Phenomenal tick, we've achieved that. There's our gold nugget. 2, never pay capital gains tax or income tax again on income derived from your investment properties once you're retired. Well, I've already covered off the tax rates. So once you reach retirement age, your preservation age, and you start drawing an income from your super, any assets that are supporting that income are completely tax-free. So you can draw income, zero tax, zero capital gains. So it's phenomenal. Even though you buy the property now, you sell it in 10 years' time, you initiate that capital gains tax event when you're retired, tax rate, zero. It is phenomenal. It's a tax paradise. Reduce the time it takes to save a deposit by over 50%. Now, this stuff is pretty good. Oh, I'm doing fist pumps. Let's look at an example. John is 30. He earns 100 grand per year. Now, this is an interesting situation because I speak to many people and they can relate to this story. He receives a pay rise of 10 grand after tax. Now, many people, they receive a pay rise and 12 months later they look back and they think, shit, what have I done with that extra income? They look back and think, how did I survive and meet my ongoing expenses on less money 12 months ago? It's not because our cost of living is continually increasing. It's just our lifestyle and our habits change very quickly when we've got more money in our back pocket. Usually when people receive a pay rise, they spend it and they increase their obligations, their mortgages. Tax obviously increases straight up. Superannuation contributions increase. They go buy a bigger house, bigger car, and it's gone in an instant. So John realizes that. John's going to be proactive. He receives a 10 grand pay rise after tax. He wants to buy a property. He needs to require to come up with a deposit. Excuse me one moment. Sorry about that, just had a bit of a cough. So he needs to come up with a 60 grand deposit. So with a 60 grand deposit, if he is saving it up for a deposit, it's going to take him quite a period of time. So let's look at the time it's going to take him to save that deposit using his own name versus using superannuation. So in John's individual name, so if it's $10,000 after tax, the actual pay rise before tax is $15,873, that number just there. So he's actually received close enough to a 16 grand pay rise. Number of years to save the deposit is simply 6 years, because when we're saving for a deposit, it's saved in after-tax dollars, not before tax. So it's going to take him 6 years to accumulate the deposit. Now, in 6 years, a lot of things can happen to property. In fact, the property that he may want to purchase has probably gone up a fair amount in value over a 6-year period. So he wouldn't need 60 grand, he might need a lot more by the time he saved enough for the deposit. Let's look at superannuation. Now, superannuation, what John is going to do is, rather than taking that $10,000 pay rise as income, he's going to salary sacrifice the entire amount and put it into superannuation up to his concessional contributions limit. Now, that's very important. Concessional contribution is where you put the money into superannuation pre-tax. So it includes any salary sacrifice money and also the 9% of your income that's going into super as your compulsory superannuation contributions. Now, the cap is 25 grand. So the government recognises the huge incentives and the tax benefits you gain for putting money into super. They've proposed a restriction on the amount that you can get in there and claim a deduction on it. Claim the tax benefit on those contributions. So what we're going to do, because he's on 100 grand, $9,000 is going in as his normal 9% contribution, and we're going to salary sacrifice the full $15,873. And that's going to be very close to the $25,000 limit. Now, it's important to seek advice around that limit because you don't want to breach it. Inside of superannuation, we're going to salary sacrifice the $15,873, put all of that into superannuation. You've got the employer contributions of 9%, which is 9 grand going into super, which is $24,875. As you can see, it's less than the 25 grand limit imposed. Got to pay tax on that, tax rate at 15% for John, so he pays $3,731. So when you look at the amount of money he has available inside of superannuation for investment purposes, or in this example, to save up for the deposit, he's actually got 21 grand. $21,144 to be exact. To save up the same deposit, 60 grand inside of super, will in fact only take 2.84 years. So it's less than 50% of the time John can save the money to purchase the property, the same deposit, just by simply using super as opposed to in his own name. So we reduce the time it takes to save a deposit by over 50%. Not by being creative, just by simply utilising the pay rise in the most effective vehicle available for investing, and that is superannuation. So 6 years versus 2.84. You choose which is the better vehicle. So 4 reasons. We've reduced the real cost of investment property by up to 40%. Never pay capital gains or income tax again. Yeah, it's another golden nugget. We've reduced the time it takes to save a deposit by over 50%. So hopefully you're taking a few things away. And I know I'm going quick, but if you can take a few things away from this, then that's great. All that you need to ask yourself is that whether sticking with an industry or a retail super fund is going to serve you better than setting up a self-managed super fund and taking control of your retirement savings, what should become your biggest asset. And then also on top of that, what are the investment alternatives available? One of the investment alternatives available is buying direct residential property and utilising gearing. Take advantage of land tax thresholds available for properties purchased in a self-managed super fund. Now this is phenomenal. Land tax is a crazy tax that's imposed on investment properties that are held. Throughout Australia, what's exempt from land tax is generally your principal home of residence and property deemed agriculture, so for agricultural purposes. So investment property that you own is counted towards land tax thresholds. Now, land tax thresholds in New South Wales, the current land tax threshold is $396,000. In Queensland, there is a different land tax threshold. Likewise, Victoria, Western Australia, Northern Territory, the land tax threshold is in fact zero. There is no land tax payable in the Northern Territory, which gives it a good advantage over some of the other states. Although I'm not recommending buying property in Northern Territory, because while that is one advantage, there is also a lot of negatives about buying property in that region. So I'm not saying if it's good or bad. In fact, you can get a high yield in the Northern Territory at the moment in Darwin. But look, I'm not the one to tell you where to buy a property. That's why we team up with experts such as the guys at Positive Real Estate. So John already owns two examples. Let's look at another case study. He owns two investment properties outside of super, all in New South Wales, and the combined land value of those properties is $396,000. So when determining land tax, it's not actually the purchase price or what's deemed the value of the overall property. It's only the land component. So the local council usually gives you a land and rates notice that should have the deemed land value of the property within that land that rates notice. So 396 grand. Currently, the threshold is 396 grand. So if you own investment properties and the land value is deemed to be below 396 grand, there is zero land tax payable. But as soon as you go over $396,000, you start paying land tax on that component. The land tax in New South Wales is 1.6% plus $100 per annum. This is every year. It's a state-based tax, so it depends on the state that you're looking at. So if John buys a property outside of super, he's up for land tax on the entire $360,000 value of that land. Land tax payable is $5,860 per annum on that additional property. Because remember, he already owns two to the value of $396,000 outside of super. Now let's look at buying it inside of super. Because he buys it inside of super, a self-managed super fund is classified as a complete different entity to John as an individual. So if he buys it inside of superannuation, he gets the benefit of the $396,000 threshold again. So $360,000 is below the $396,000 threshold. So in fact, the land tax is zero if he buys that property using his super through a self-managed super fund. So it's $5,860 better off every year just by reducing the land tax by buying that property inside of super. Over a 10-year period, it's $58,600 better off by utilising super. So there's huge advantages. Another way you can take advantage of land tax is simply by buying properties in different states. Now, I know a lot of people like buying it around the corner, but it's not necessarily the best property for you to move forward. If it's simply to avoid land tax, then it's a good start. Of course, it's a state-based tax. If you buy properties in different states, you get the benefit of the threshold in each state. So you buy property in New South Wales for 360 grand land value, you pay zero land tax. You go buy the next property in Queensland, you get the benefit of their threshold, so it starts from zero again. Had you bought that second property in New South Wales, it may increase above that threshold amount where land tax is payable. So first and foremost, by buying in different states, you're going to get the benefit of reducing the total land tax on your properties. By utilising super, you're able to reset the threshold again in each state. And also, combined with all those things, is generally different states operate in different economic cycles. So if you buy a property just around the corner, it's generally going to go up or down in line with your principal place of residence. If you own all properties in the same suburb, you're not gaining the benefit of diversification. If you buy in different states, for instance, Perth has been thriving over the last 10 years, where New South Wales or Victoria, Queensland, in the cities at least, haven't gone up as much. So because you've got it in different states, you get the benefit of different economic characteristics and you gain the benefit of diversification, which is another reason we've teamed up with Positive Real Estate. They've got a presence across the entire country sourcing property, of which we don't have time to go out and research ourselves. They've got the experts on the ground that specialise in that, and they've got the buying power to ensure we get a greater purchase price than we would otherwise do trying to go it alone, which is all good. So land tax is phenomenal. We can reduce, in this example, we're $58,600 better off over a 10-year period by simply utilising super as opposed to outside of super if John bought it in their own name. Now let's look at property. Now many people say property is the same in inside of super or outside it. Well, I beg to differ. When you look at property, what makes it a very good investment to consider for superannuation is because it is one of two assets that I know of that actually provides both income and capital growth potential over the holding period. For instance, if you look at fixed interest as an example, if you put money in the bank account or a term deposit, generally they provide you an income. However, there's zero capital growth potential of owning those assets. When you look at property and shares, though, and the majority of shares, they're generally assets that increase in value, or what's deemed productive assets, in that they've got the capacity to enjoy capital growth over the long period and also income along the way. Now, with shares, it's dividends. With property, it's rental income. So property and shares are considered good asset classes to consider inside of superannuation because it encompasses both. Let's look at it for property. Because it provides consistent long-term returns, and that's actually measured in two types of returns, being capital growth and rental income, it's ideal for you to consider inside of superannuation. Let's have a look at it. When you look at buying individual properties, you've got to choose, or individual assets or shares, you've got to have to choose which one of capital growth or rental income is more important. Now, many people say that they're mutually exclusive. That is, that if you choose high rental income, don't expect high capital growth. Or if you choose low rental income, you're hoping for high capital growth. Well, what's more important? Now, my mum, back in 1996, I had the benefit of saving up. My mum was a great teacher. When it came to investing and saving money for the future, I had $25,000 in total saved up. And my mum took me, I grew up on the Central Coast, my mum in 1996 took me up to Cessnock, which is a regional town just inland from Newcastle. Back in 1996, you could buy a property in that town for $26,000. 26 grand, the real estate agent took us around the roads and showed us a few properties around the $25,000 to $30,000. He looked at us and said, look, these provide high income. The rental income for those properties was between $150 and $200 a week. So there's phenomenal rental income coming through when you consider the purchase price of that property was between 25 and 30 grand, the stuff that we looked at. Now, I didn't buy the properties, unfortunately. I wish I had. But the real estate agent who was trying to sell us the property said because it provides high rental income, don't expect any capital growth. Now, this stuff's out in the region. Like there's not much reason why the properties will increase in value. So you're buying it for income and income alone. That was 1996. We go forward, what we're talking 16, 17 years on, to buy a property in Cessnock, the same property, there's been no money spent on them. It'll cost you around $300,000 to $400,000 just to get into those areas. Like Cessnock is the hub of the Hunter Valley region, which obviously is thriving on not just the mining boom, but also agriculture, the vineyards, and tourism. So the property, while the real estate agent thought that, look, because of the high rental income, you're not going to get capital growth. In fact, I received both if I had purchased that property. So what's more important? Are they mutually exclusive? Not at all. I think you can gain both of them together. Now, what's more important? Well, let's look at what's more certain, or what's less influenced by economic movements. Now, capital growth. Many regions around Australia right now, if we look at regions like the Gold Coast, Portsea in Victoria, or Palm Beach here in Sydney, if you look at those regions, I'm just naming a few and making good generalisation of those areas, but there's properties that I can find that you can buy now for close enough to 50% below what it would have cost you to buy those properties 5, 6, 7 years ago. Now, the capital growth in those regions may have been high, but they were influenced by the economic movements called the GFC. So what is more certain? Rental income or capital growth? Capital growth is more volatile to economic circumstances, where rental income, I know with a high degree of confidence what my rental income is going to be next week, next month, next year. Rental income is less volatile to economic movements, where capital growth, you really are only certain of capital growth the day you actually sell your property. So you're planning on selling it in 10 years' time, and 12 months prior to that 10-year period, there's another GFC. That's obviously going to influence the capital growth over that entire holding period. So for me, when I look at investment inside of super or outside of it, rental income at least gives me greater certainty that I'm going to receive a return. Capital growth is pie in the sky, crystal ball sort of stuff. I've got no idea what that will be. And while some areas offer higher growth capital growth potential, it is just forecasts. Now, the other thing that what rental income gives us is the ability to service a loan. If you look at capital growth, unfortunately the banks don't consider the capital growth area when giving you a loan, because the capital growth isn't going to pay that ongoing interest expense. I'll show you an example. Tom's 50. He earns 60 grand per year and has 300,000 in his self-managed super fund. Now he wants to buy a property. Now this is going to highlight the difference of yield. Property, he's going to look at buying a property that is in a high growth area, and the rental income's not bad. It's 4.2% per annum, so it's modest and pretty good rental income. Let's look at the scenario. He goes to the bank and says, look, I want to borrow money inside of my self-managed super fund to fund the purchase. Purchase price is 600 grand. He needs to borrow money because he's only got 300 grand. He needs to borrow the other $300,000 to fund the purchase. In fact, he's going to borrow 350 grand. The other 250 grand he's going to contribute out of his self-managed super fund. The rental income at $480 per week equals $24,960. Now, if we're going through the serviceability calculator that the bank uses, the bank doesn't apply 100% of that income to determine your ability to meet the interest expense. They're obviously going to include a buffer. So when they're looking at rental income, when they're calculating your ability to service the debt, they actually only count 80% of that rental income. So rather than being $24,960, $960, they actually only apply 80% of that. Your superannuation contributions, Tom is earning 60 grand, 9%, $5,400. They actually count 100% of those contributions, because I think there's a higher chance of you making those contributions because they're compulsory. So when they're assessing your ability to service the loan, they adjust the income. So the adjusted income for serviceability calculations alone is $25,368. Now, what the bank also looks at is they apply another buffer in that they amend your income, but your adjusted income needs to cover 110% of the interest expense. Now, the current interest rate that you can borrow inside of superannuation before the rate cut yesterday at least, the fixed rate for a 3-year period is 5.74%. So almost as cheap as what you can borrow it in your own name. And I'll argue probably just as cheap, if not cheaper. So over the last few years, there's increased competition in the banking environment to provide SMSF loans to fund a property. So because of that increased competition, the rate for the loans has come down. So let's look at 7% though being the interest expense, not 5.74. So the interest expense is $24,500. So you can see $24,500 versus 25. You've got enough money even after their adjusted income. But because of the 110% buffer, they're not going to get the loan. Their serviceability coverage is only 104%. So because it's not 110%, it's going to be declined. So this is just on rental income. Now, who cares what the capital growth potential is, or what the actual capital growth is actually realized over a 10-year period? Because in this instance, Tom hasn't bought the property. So even if it doubles in value, if he doesn't own it, he's not going to enjoy in that capital growth potential. So irrespective of the capital growth potential of property looks like it's going to achieve, rental income, I believe, is the number one characteristic, because it's going to give you the ability to buy the property in the first place. So let's look at another example. Tom, same scenario here, except he's looking at buying 2 properties in 2 different states to reduce their land tax liability and also to gain diversification. But this time the rental income on those properties is 6% per annum. The purchase price isn't 600 grand, it's $300,000 each. So the total purchase price is 600 grand, in line with the example in scenario 1. This time it's 2 properties at 300 grand each though, rather than 1 at 600. SMSF loan, 350, so the same. The rental income now is $350 per week on each property. So the total rental income at 6% is $36,400. Again, the banks adjust that. They apply a 20% discount, so they include 80% of that rental income in the serviceability calculations. Super contributions, $5,400. They count 100% of that. So the bank's adjusted income is $34,520. Annual interest expense is the same, $24,500, which gives us a serviceability coverage of 140%. We just need to be above 110. So the bank approves it. The only difference here is the rental income. We've gone from 4.2% to 6%. Because of the high rental income, we've been able to buy the property and borrow to fund the majority of the purchase. Now, with this serviceability coverage, we can then use the excess income to add to the serviceability of future loans to go buy more and more properties inside of superannuation. So it doesn't restrict us in an ability to go buy more and more property from a serviceability perspective, and that alone. So as you can see, rental income or capital growth, rental income for me is the number one characteristic, because it should be able to give me access to the property in the first place, because to fund the purchase I'm going to have to borrow the money, and the majority of us generally do, to buy a property. So that's banks and serviceability. Now with Positive Real Estate, again, they specialise in properties that are providing a 6% plus rental income. So they look at the high yielding properties around Australia, which is good. So let's look at reaching your retirement goals. Let's look at a case study, a total cost case study. This is what I'll finish on. There's about 4 or 5 different investment strategies and contribution strategies that we're going to use in this this case study. Again, hopefully you can apply 2 or 3 of the strategies. If not, just one, then it's good. So the case study is just to give you a real life example to apply to your own circumstances in some way, shape or form, just to learn some of the things that are capable inside of superannuation. So Peter and Anne. Now Peter and Anne's not their real name, and that's not their photo over there. They certainly don't own a boat, and they're not that good looking. Peter and Anne are actually pretty ugly. So I'm just using Peter and Anne as a case study in this this example. Peter's 45. He's got a super balance of 140 grand. Anne is also 45, super balance of 85k. So a typical Australian couple. Combined super balance is 225,000. P's income before tax is 100 grand. He works as an accountant. Anne works part-time as a teacher, earning 31,500. They pay a bit of tax when you combine the two of them each year, which means their after-tax income is just above $100,000 per annum. That's how much money they've got after tax each year. Why that's important is their number one goal once they reach retirement is to maintain $100,000 per annum in income, passive income, where they don't have to work for it. Now, if I asked you the question, would you love to be earning just as much as you are now but not have to work for it in retirement? I'm sure the majority of you would say, yep, sign me up. That's what I want to achieve. Peter and Anne want to retire at 65. Or possibly earlier if they've got the capacity to. But their number one goal is to maintain that income of 100. So if it takes them a few more years to 65 to accumulate that, then they're okay with that circumstance. They also want to own their home debt-free. They currently own a home. They've got a bit of debt on it. My objective is to grow Peter and Anne's assets so they can draw $100,000 in income after tax forever. Now, this is important because while they own their own home, well, I think they've got a $600,000 house with a $350,000 mortgage, and there's 15 years remaining on the principal and interest repayments. What many people think is an asset is their principal home of residence. And I agree, principal home of residence is an asset, but it is not an income-producing asset. Peter and Anne have got teenage kids, and they've registered their kids to go to university and in a different state. They want them to go to a different state so they can move out of their house. The last thing they want to do is bring in backpackers renting out rooms to fund their lifestyle in retirement because they have to. What we want to do is to produce an income earning capacity asset, so income producing asset on top of their principal home of residence that's deriving $100,000 a year in income per annum forever. Now, a lot of financial planners, a lot of people start drawing off their capital. They use their capital to fund their shortfall to maintain their retirement. But that causes 2 problems. One is that you can outlive your retirement savings. If you're eating into your principal, that means you're eventually going to run out of it. And the last thing you want to do is to outlive your super fund. Of course, the economic consequences are pretty dire because you'd be on to the pension, which is, $360 a week or a fortnight, not that much. The other one is that Peter and Anne, rather than doing what many people are doing today, is spending their kids' inheritance, is that they want to pass on their assets to their kids. So they don't want to eat into the principal at any time. So my job is to develop assets so they can draw $100,000 income, and also to have them pay off their mortgage. Now, to draw $100,000 income per annum without eating into the principal, we need to accumulate in their individual names around $2 million. to be able to draw off $100,000 income, just below it. Within super, we only need to make 1.68 mil. So it's like $300,000 less inside of super. It's so much easier to achieve our retirement goals inside of superannuation simply because of the tax rate. If we accumulate assets in our own name, we'll be paying tax at our marginal income tax rate. If we do it inside of superannuation, the tax rate once you reach retirement on income is tax-free. It's like being in a 100-metre race. You start at the 100-metre line and the super fund, self-managed super fund, starts 40 metres from the finish line. Obviously, you can reach your goal, being the finish line, a lot easier starting 40 metres away from the finish line rather than 100. Inside of superannuation, because it is a tax paradise, it is sexy, it is phenomenal in that you've got a greater chance of reaching your retirement goals. Time frame, 20 years, so they've got a fair few years, because remember they're 45, and they're planning on retiring at the latest at 65. So we've got 20 years. At the moment, though, they have bugger all income-producing assets. So we've got to get their money working hard for them straight up. They realise that leaving in an industry or retail super fund earning 3% per annum is not going to reach their retirement goals. So let's look at Peter and Ann. They decide to buy an investment property using their self-managed super fund. So they set up a self-managed super fund. They look at buying an investment property. And they also, because to fund the purchase of it, they're going to need to borrow. They use an SMSF investment property loan. So let's go through the assumptions. Investment property is rented for the entire term. Now, obviously, when you come out with some forecasts, you need to make a few assumptions. I hope I've been conservative when developing these assumptions. And if there is a material change in these assumptions, it's obviously going to have a big effect of the end result. 6.5% is the annual growth rate. So I'm not telling you it's going to go up 10% per annum or double every 10 years. 6.5% is the annual growth rate. Russell Research Report recently came out. The average return over the last 20 years for property is just around 11% per annum. Rental income, maintenance, insurance, rates and taxes, all of the fees and expenses, and the rental income increases by 3% per annum in line with inflation as an assumption. Interest rate for borrowing is 6.74% for the entire period. So you can borrow now at 5.74, but let's assume interest rates aren't going to stay at these low levels. Well, that was before the rate cut a few days ago, so it's probably less than that now. In 2012, tax rates and superannuation laws apply for the entire period. Now, we know that's not going to be the case, because remember, by 2020, superannuation contributions is going to go up to 12%. So they're going to have more and more money going to superannuation, which should improve the result on this outcome. Also, I realise that the government is going to change the rules around superannuation, but generally, the majority of the time that they have changed the rules, it's made superannuation even more attractive as an asset class to save for retirement. And why the government continually improves the conditions for superannuation and why they make it so attractive for us to put more and more money into superannuation is simply because they need us as a population to become self-funded retirees. If we all rely on the pension, then the cost to the economy and the government in the future is going to be astronomical. That's why they want us to save more and more money. They realise that if they relied on us to save for retirement in our own right, we wouldn't have the patience or the discipline to do so. That's why they make it compulsory and why they make it so attractive for us to put more and more money into super. So the first property they go buy a property in Mackay. Now, here's the property in Mackay. I'm not the property person going out and looking at Mackay and why Mackay is a good region. If you look at some of the key statistics like infrastructure spending, they're looking at spending a lot of money. They've obviously got a huge exposure to the mining boom, but the good diversification in it, they're not reliant on the mining boom. They've also got agriculture. The shopping centres, hospitals, there's a huge amount of infrastructure that's being built around the Mackay region. It's a gateway to the Whitsundays also. So that all sounds good in that that's all got to do with the upside capital growth potential. But as I said, that's pie in the sky sort of stuff. We don't know what the capital growth will be. Well, I know what I know and I know what I don't know. What I don't know is what the capital growth of these properties will be or any property is going to be over the next 10, 20 years. What I do know, though, is if Peter and Ann buy this property in their own name, it's going to cost them a lot more than what it will the real cost in them buying it inside a super fund. their self-managed super fund, buying their self-managed super fund, the cost is going to be about 40% less for Peter and Anne. What I also know is that if they sell the property when they reach retirement, they won't be paying any capital gains tax if they buy it inside of their super fund. So a few things I know and there's a few things I don't know. The rent, $700 per week. The cost of the property, $400K. Now this rent at $700 per week, close enough to 9%, is actually a 5-year rental agreement. 5-year rental agreement, and after the 5 years, the people renting it out have to make good the premises. So they've got to renovate it back to the state that it was in prior to it. So great investment property. It's all managed from other people, experts, as opposed to us. So irrespective of the region, you can manage this property simply because you've outsourced it to other experts. And for me, rental income is the number one characteristic that I'm looking for. So the gross yield 9%, that's a good investment. Let's look at the result. 10-year period. 10-year period, the property is going to be worth over $700,000, assuming 6.5% growth per annum. Because of our contributions and the high rental income, we're going to pay down this property within a 10-year period. So in 10 years, property value is going to be $734,000. The net rental income by that time will be $37,000, assuming a 3% increase per annum. Total super value just less than $1 million. Now, Peter and Anne started with $225,000. In 10 years' time, do you think that they can go from $225,000 to $1 million, close enough to it, by simply leaving it with a retailer industry super fund? Well, looking at the performance over the last 10 years, they're going to come up well short. The one reason that self-managed super funds have grown so much is simply because they get a huge competitive advantage in that they can go buy direct residential property. Big industry retail super funds cannot do so. And they all can also, a self-managed super fund can also borrow to fund the purchase. For the majority of retail and industry super funds, they're not willing to borrow at all. So we get the benefit of leverage. Now here we've assumed the capital growth of the property is up at 6.5%. Now if the property falls in value, obviously because we've got a high level of gearing, we've got the capacity of losing a lot of the super fund value. If you're borrowing at 80%, the property value falls by 20%, you can lose your entire contribution. So it's very important to implement diversification, not just to get across asset classes, but also properties. It's worthwhile considering that at least. There's no hard and fast rule that you have to diversify. There's no rule that says that you can't put 100% of your money into one property or property in general. But you've got to at least consider the risks associated with doing that. So super value is $994,000, assuming 6.5% growth over the entire period. And we've paid off the entire property in 10 years. Pretty good. That's 10-year projection. However, you look at Peter and Anne, that's not going to achieve their lifestyle goals. We need their super fund to be worth $1.6 million over the entire period. And they've got more money in super. So they start looking at it and think, shit, we've got to get more money working hard for us. So they think property is working well for us. Let's go buy more properties. They're property passionate people. Because they've taken control of their super fund, they control where they invest it. So they're choosing property, the old-fashioned way like their parents have enjoyed and accumulated to become self-funded retirees. So they go buy more property. But the problem is they can't afford it. They've got no surplus income. The bank won't lend them any money inside of their self-managed super fund because they're already utilising all of their income, being the rent, and their contributions to fund the obligations on that first property. They also can't go buy it in their own name because of that rat race. They've got no money to meet the interest expense in their back pocket to fund the purchase. So they're at loggerheads. I'm sure many viewers, listeners, reach that point where they'd love to go buy property. Like there's plenty of opportunities that exist out in the marketplace today in many regions. I mentioned a few of those regions before where property are trading 50% below what they were sold for 5 or 6 years ago. There's plenty of opportunities out there, but the majority of people can't do anything about it simply because the bank won't lend them any more money. So they want to go buy more property. But because of the serviceability requirements of the bank, they can't. They can't buy it in their own name. So what they need to do is start looking at being a bit more savvy and smart with their expenses. So they've got no surplus cash flow. How do they go fund more properties? Let's have a look at it. Contribution strategy. We need to get more money put into superannuation. Contribution strategy number 1. Home loan interest repayments adjustments. Now, Peter and Anne, they're paying principal and interest. They've got no cash flow to put into superannuation, so what we need to do is reduce one of their biggest expenses. So what we're going to do is convert their home loan repayments from principal and interest to interest only. Now, many people do that, and the cash flow savings that they receive from making that conversion, they go spend. Now, obviously, that's the worst thing you can do, because if you go spend it in 15 years' time, Peter and Ann are still going to have the loan of 450 grand on their home, which isn't achieving their goals. If they pay principal and interest, that's going to become zero in 15 years' time. But what we need to do, rather than spending it, is to put that money into the best tax-effective vehicle to accumulate assets over time. So what we're going to do is convert to interest only from principal and interest, and the cash flow savings, we're going to put it into superannuation. And we're going to put it in by two ways. Let's have a look at it. So convert home loan repayments to interest only, then we're going to put in the first amount into superannuation as a salary sacrifice, as a concessional contribution, remember, pre-tax, into Peter's superannuation, which is the same self-managed super fund. So Peter's going to make it a contribution up to his concessional contributions limit, up to 25 grand. The additional cash flow savings, we're going to put it in as a contribution in Ann's name. I'll go through why. So let's look at Peter and Ann. Home loan repayments. Current mortgage repayments are $38,687. We convert to interest only, it's 27 grand. So $11,687 is a cash flow savings. Now, when you're paying your interest on your home loan, on your mortgage, is it in before tax dollars or after tax dollars? For us all, it's in after tax dollars. So the cash flow savings is $11,687. To have that in after tax, Peter pays $6,865 in tax, which means if you add that back to what he's receiving after tax, is $18,552. So the real savings is $18,552 before tax. Peter's going to salary sacrifice $16,450 and put it into superannuation as a concessional contribution. Goes in pre-tax. Now we're only doing $16,450. You'll notice these two numbers are different. Is that will take him up to his $25,000 concessional contribution limit. He then pays super tax at 15%, $2,467, which means his after-tax super investment is $13,983. So he's getting more money into super. Because he's doing this each and every year, what the bank looks at is a regular contribution, regular income going in, so they would include that in their serviceability calculations. So more money is going into superannuation, which improves their ability to borrow to fund future properties. Contribution strategy 2. So we've still got around $1,500 left over. So what we're going to do is make a contribution into Ann's superannuation, which is the same self-managed super fund. It's just going to be a contribution by Ann. Why we're going to use Ann's name is simply because she gets entitled to the government co-contribution scheme. Now, many people have heard the government co-contribution scheme, yet very few actually implement it or take advantage of the government co-contribution scheme. The government co-contribution scheme is an automatic guaranteed way to make 50% return on your money. Guaranteed way, provided you meet certain characteristics. It's entitled to the full government co-contribution. You need to earn less than $31,920 currently. So if you earn less than $31,920 and you make a non-concessional contribution, which is an after-tax, so money out of your back pocket, if you make a non-concessional contribution, the government will match 50% of every contribution you make. So you put $1 in after-tax money, they'll put an additional 50 cents. Now that's up to a maximum of $500 for the government co-contribution. So you put $1,000 in, or Ann puts $1,000 in after-tax dollars, the government will put in an additional $500 each and every year, if the rules stay as they are. If you earn more than 31 grand, don't worry. If you earn less than $46,920, you are still eligible for some form of government co-contribution. It won't be $500, it might be a bit less, but the government will still give you an incentive to put more and more money into superannuation and after-tax dollars. Now, if you earn more than $46,920, you're not entitled to any form of government co-contribution scheme, because the government recognises you're already receiving a huge amount of tax incentives to save for retirement. You don't need any more. So Peter and Ann earns $31,500. Because it's below $31,920, if Ann makes a non-concessional contribution after tax dollars, she's entitled to the full government co-contribution scheme. So Anne's going to put in $1,323. She doesn't need to put in $1,323. She only needs to put in $1,000, but we're assuming the entire cash flow savings now goes into superannuation. She puts it into super after tax. The government will invest another $500 into Anne's super as a co-contribution each and every year. Remember, we're doing this every year, not just one-off. So it's an immediate 37% gain on Anne's investment. Had she only invested $1,000, it would be 50% gain on Anne's investment. Also, contribution strategy 3 is the low-income super tax rebate. Because Anne's income is below $37,000, the government will rebate the entire tax she pays on contribution up to $500. But because her income was $31,500, the 15% contributions tax on her 9% income going into super is going to be rebated, which effectively means that the tax rate for superannuation contributions for Anne is 0. So because Anne's income is below the threshold, any super contribution tax is rebated back to SMSF. So the government will rebate every year $425 tax that Anne has effectively paid, which reduces her super contributions tax to 0. Phenomenal! Like this stuff is sexy. I hope you see how sexy it is too. Hopefully that's another golden nugget you can take away. So because we've got more and more income going into superannuation, we've improved Peter and Anne's serviceability within their SMSF. So the bank's now going to lend them more and more money. Because they've got a lot of equity still sitting in their SMSF, we haven't utilised it all for the first property. We're going to go buy more and more properties. In fact, Peter and Anne are going to be very aggressive. And I'm not recommending to be this aggressive, but look, these people are very passionate property people. All I'm trying to show you here is some of the capacity and what you can achieve inside of Self-Made Super Fund by utilising property. It's by no means a recommendation because the risks of being this aggressive are quite high. So Peter and Anne have added a further $16,231 into their super every year. And it hasn't affected their own cash flow. Remember, all that we've done is reduce their biggest expense. They've still got as much disposable income in their back pocket as they had prior to implementing any of these smart, savvy strategies. So we're putting more and more money into super, so it improves the bank serviceability so they can go buy more properties. So they go buy more properties. They decide to buy one property every year for the next 4 years. So in 5 years, they're going to own 5 properties, all held within their self-managed super fund. They're going to look at buying them in different states simply to avoid land tax or to minimise their land tax bill, and also to achieve diversification. They just don't want to be exposed to one economy being Mackay. After 5 years, they're just going to leave them there to accumulate. So the second property is in Newcastle. I went to Newcastle University, so I know the place well. This is in Jesmond. It's very close to the local university and the hospital. So from a rental perspective, there should be a high rate of tenancies and a high rental income because of nurses and doctors wanting to be close to the hospital on at-call duties, and also university students. Not that they're the ideal tenant. It's good that you've got a diversified mix of industries that can support the rental income of the property. The rent is $430 per week, a 3-bedroom townhouse, $317 off the plan. Now, it's important to work with specialised property developers in this space, which PRE do. Last month, they sold 80 properties. They organised 80 properties for their clients. So when they're buying 80 per month, they come with a lot of buying negotiating factors. So where a developer goes to them and say, hey, look, we've got a development coming up, and they go, well, we've got a lot of people in their self-managed super funds that want to go out and buy a property. They tailor the contracts to be suitable for a self-managed super fund. And the contract's very important, especially if you're looking at buying off the plan. One of the restrictions of buying and borrowing money to fund the purchase of property in an SMSF is that it needs to be a single acquirable asset. What that means is that it's got to be one asset. If you're buying an off-the-plan property, it used to be a 2-part contract. One asset would be the land, the second asset would be the contract to build the property, so all the material and the labour. That's a 2-part contract, so that is not a single acquirable asset. That is 2. So you can't borrow money to fund the purchase, the development of a property unless it's a single contract, 1-part contract. If it's a 1-part contract, you can buy off the plan properties and borrow to fund the purchase to do it. So Positive Real Estate go around to developers and ensure that they're providing single contracts, 1-part contracts to enable us to buy these things and gain exposure off the plan properties where we can potentially save a lot of money on our entry level, and with their buying power save a bit more. and come out hopefully in front. So we're buying the property off the plan and able to do so by using PRE's negotiating ability. Rent $430 a week. Pretty good. Third property, we're going to go back into Queensland, Townsville. Again, plenty of reasons why there's infrastructure being spent and that there's high growth, capital growth prospect in the future. But for me, that's irrelevant because it's all uncertain. What I'm looking at is at rent. The rental income, $810 per week for a two-bedder. It's going to cost me $450,000. All these properties, we're assuming we're paying 20% deposit, and all the other additional costs like stamp duty, set up the Bear Trust that you need to buy the property in a self-managed super fund, all out of their SMSF cash. Property 4, we're in Muswellbrook. Purchase price $298,000 for a two-bedder townhouse out at Muswellbrook. That's just out of Newcastle. Again, one of the good things about Muswellbrook is there's 2 coal-fired power stations, which provides 40% of the power to New South Wales. There's a third plan, plenty of infrastructure being built in Muswellbrook, and a huge demand because of their reliance on coal, which is a bit of a risk down the track because it is generally one sector that's funneling the growth. However, when 40% of the power is coming from Muswellbrook's power stations, that's going to be there for quite a period of time. Two-bedder, $298,000, rent $380 per week, 6.5% yield. Property 5, we're over to WA in Bunbury. Purchase price $209,000, rent $285 a week, yield 7%. So what we've bought in 3 states, we've been able to avoid with all of these properties the entire land tax. Had we bought the properties all in one city or one state, there would be land tax payable. So we've bought one every year for the first 5 years, and then we're going to sit back and look at the result. So if we're assuming 6.5% capital growth per annum, let's look at the result over the 20-year period. Now, this is phenomenal. In 20 years, their net superannuation value will be over $5 million. $5 million. Super value over $5 million. But to get there, what we've had to do is to convert interest from principal and interest to interest only, which means we have a $450,000 mortgage still outstanding. Because Peter and Anne are now over the age of 60, their preservation age, in fact they're 65, they've retired, they're starting to draw an income from their super fund. What they can do is sell a property or draw a lump sum of $450,000 out of their super fund, completely tax-free, and use that money to pay off the debt on their home. Net rental income, $178K. So their total super value is $4.6 million. $4.6 million is the total after you pay off all of the debt. $4.6 million. What was our target? 1.6 something. So we've well and truly exceeded their goal and our goals. The reason we've achieved that result is simply because we've bought property and we've been able to fund the purchase through gearing. 6.5% isn't a huge forecast, but obviously if it's not 6.5%, if it's less, it's going to have a huge impact on that outcome. Now let's assume it's half that. If it's half 4.6 mil, it's still 2.3. So it's half that growth is still $2.3 million is the net superannuation value. Again, it's very hard for a retail and industry super fund to compete with property, especially when you're borrowing. So what have we done? Peter and Anne have paid off their mortgage. They've created $4.6 million in wealth inside of superannuation. They can draw a retirement income of $178,000 from their super completely tax-free. Remember, their number one goal was to draw $100,000 in income after tax from their super. We're at $178,000. So if they just wanted to maintain that $100,000, they could in fact retire 8 years earlier, achieve their goals of retiring earlier. This could be you. Time taken 20 years. We've reached their goals actually in 12. Simply by utilising the old-fashioned way of accumulating wealth inside of super, by utilising property and borrowing to fund the purchase. Now again, there's obviously high risk associated. If we're borrowing at 80%, the properties fall by 20% in value, and they're forced to sell those properties by the bank, then that can erode your entire superannuation balance if you have 100% of your super money in property. So it's important to consider diversification. It is also important to consider all types of insurance to ensure you avoid from being forced to sell a property. Insurance like TPD insurance and life insurance. If one of the members of the super fund, which are relying on their contributions to meet the ongoing interest expense inside of your self-managed super fund, dies, then you're not going to be able to afford the interest expense on those loans. If they have a life insurance policy though, or TPD insurance, if they're totally or permanently incapacitated, so they don't die but they still can't earn money, you can get a lump sum. By having these insurances, you can pay off the debt inside of superannuation and avoid having to sell those properties at the worst possible time. You can also take out tenant risk. So if a tenant doesn't pay rent, and it takes you 6 months to kick the pricks out, that obviously, because you're not receiving rental income, you're not able to service the loan, it may force a bank to look at selling that property. By having tenant risk, you can avoid that. Also, take out insurance from a tenant destroying your house. These are all risks that you take on by being a property investor. They can all be managed by having insurance. So it's important you consider all types of insurance, especially when you're looking at utilising geared money, borrowed money, inside of super. What you want to do is avoid any possible chance of the bank having to sell when the market is down. And like all things, property goes up and down, and in our own lives, life's about cycles of ups and downs as well. Cost of them, zero. It's cost nothing out of Peter and Ann's back pocket. All they've done is being smart and savvy and reduced their biggest expense. They've converted their biggest expense, being their mortgage repayments, from principal and interest to interest only. So borrowing to buy a property inside a super, you've got to do a few things. First and foremost, you need a self-managed super fund. We'll let you set up a self-managed super fund. We'll do that for nothing. So we want to remove all the hurdles for you starting to take control of your what should become your biggest asset. Roll over your existing superannuation to your SMSF. Again, we'll help you with all of that. We'll do it all for you. We'll also review any insurances that you have in your existing superannuation fund and look at what it's going to cost to replicate those insurances in your SMSF, or possibly increasing them, especially if you're considering introducing debt inside of your super. Loan pre-approval for your SMSF, we can do that just so you know what sort of properties you can go out and buy. Source of property, Positive Real Estate are experts. They're experts at sourcing the properties across the country, which is your team. And you get access to Positive Real Estate's property by joining our mentoring club, our investor club. Establish a property bear trust and a trustee company. To buy a property and to borrow inside of a self-managed super fund, you need a bear trust. We'll look after all that for you. Final loan approval and settlement, Sequoia the bank and your conveyancer, we can all work together to make that happen. Ongoing administration, bookkeeping, auditing, financial preparation. Because you've got a self-managed super fund, you've got ongoing obligations that you need to meet. Now we'll do that for you. Now, if you look at the administration fee, like it's different. Ongoing, like we'll set up the SMSF for free. There is a fee associated with setting up the bear trust and corporate trustees associated with that, those sort of things. But the ongoing administration, bookkeeping, financial preparations, auditing, that's an accounting responsibility which we can help you out with. Now, if you look at the other self-managed super fund providers, the average fee, which is this figure down here, to set up is $1,238. They're all the main players. So 10 of the main players are listed there. The average setup fee is $1,238. We'll do that for nothing. The average ongoing administration fee, now this ongoing administration fee is just for the accounting work, is $3,867. What we're going to do, we're going to charge you $2,950, which comes from your self-managed super fund. This isn't a fee paid out of your back pocket. Now, for the majority of you, if you've got over 100 grand, that fee is probably less than what you're paying at a retail super fund now, because that's a flat dollar amount. Now, this is in Sequoia superannuation. So this is if you want to go out and buy a property. We will also provide you ongoing face-to-face training. You'll gain a one-on-one investment manager. There's an SMSF expert to hold your hand through the entire process. You'll also gain access to a Positive Real Estate property coach. That property coach will be out there sourcing properties that will work with you to source the right properties for your individual circumstances. You get the benefit of those two people at call 24 hours a day. You got all the accounting and the compliance work that goes with it. On top of that, we will provide you through an investment club monthly mentoring, face-to-face mentoring programs every month. That will keep you up to date with regulatory changes, investment opportunities, different property updates. We call in property experts, we call in tax experts, we call in legal experts, other investment experts to come and be a part of your team. You get access to an insurance expert, a finance expert that specializes in borrowing for a self-managed super fund. This is all a part of our service. It's an ongoing monthly mentoring program package that it ensures that you can fulfill all of the requirements of acting as a trustee inside of your superannuation. That's a flat dollar fee, $2,950 for all of that. Now, just for the accounting work, the average of the top 10 super fund providers is $3,867. So almost $1,000 cheaper, yet you get access to an at-call team to provide you all that additional services, plus the ongoing mentoring program. The average industry and retail super fund fees, if you look there throughout of it, you're paying on average 1.88%. If it's in a retail super fund, they're all above 2. Or corporate master trust, 2.41%. Their personal superannuation over 2. Retail retirement income, 1.85, 2.3, 2.42. What we also have is we introduced the mini SMSF, which I spoke briefly about earlier on. The mini SMSF is designed purely for people with low superannuation balances. Rather than being a flat dollar amount, it is a percentage. You don't get access to the mentoring program. In fact, in the mini SMSF, you can't go buy property. It's designed for people who've got between 50 and 100 grand that don't have essentially enough money to buy a property. So it's a stepping stone to get you to the SMSF Investor Club, where you get the benefit of that entire mentoring program and that call team. You do get access to the one-on-one investment coach, though. We'll probably get an invite to a few of the mentoring programs as well, just so as a trustee you're informed. The mini SMSF is 1.75% plus $10 per member per month. So when you compare the mini SMSF 1.75% versus 1.88, it's close enough to the same fee that you're paying now. With the introduction of the mini SMSF, that has opened up the floodgates so more and more people can access their money and start taking control of their self-managed super fund. The Investor Club is phenomenal. It's the only thing offered across the country that I know of where we're providing all of the ongoing support and holding your hand across not just the accounting and the compliance obligations, but also holding your hand and ensuring you're an educated, informed investor about the regulatory changes, which are changing all the time. Likewise, insurances and the investment alternatives, specifically property, with having access to that property expert from PRE in that team. It is phenomenal. So more and more people can access a self-managed super fund now. So the classic SMSF, investor suitability, if you've got over 100 grand, we'll do the complete compliance reporting, all that sort of stuff. You get online reporting for both, so you can log into our website. If you bought shares, you've got money in the cash account, the property, it's valued on a day-to-day basis, so you know exactly where your super fund is at any point in time. $1,400, we'll do it for nothing. As I said, $2,950 ongoing for the entire Investor Club. For the mini SMSF, the only difference is you can't go buy property, and it's designed for super balances less than 100 grand, but it needs to be close enough to more than 50K. So that's it from me. The next step is to register for a free one-on-one investment consultation. Again, we'll do a complete superannuation health check for you for nothing. This is phenomenal. The actual launch of the SMSF Investor Club is happening in January. It'll kick off in January for the full year. So it's the first time that we're doing it. We've got the team lined up. We've got a few experts that are going to come in that we're drawing upon, like Mark Boris, for instance, from Yellow Brick Road. We have other experts like Scott Harris, Jason Witten from Positive Group, Sam Saggers, myself, a few share experts, Michael Roberts, which is a legal expert in SMSF and wealth protection. So we've got a team of experts that are going to add on to the ongoing monthly mentoring program to ensure they're that expert. What I might do is go through some questions. If you do want to register to have that one-on-one consultation or to get more information about what we've spoken about tonight, including the DVD or the book Making Super Sexy, and also the free self-managed super fund giveaway, by all means, include your details in the questions, type your name, your contact number, and a member of my team that's in each state across the country will call you to organise a one-on-one meeting. The earlier you start taking property seriously, the more money you're going to have in retirement to fund that, to fund your lifestyle. So I'm going to try to bring up a few of the questions here. My screen isn't showing too much, so bear with me. I'll try to go back to questions. I think a few of you will ask them along the way, which is outstanding. So by all means, while you're waiting for me to bring this up on the screen, type your details in if you want to register. Great question, Shay Watts. Can the SMSF buy a property that is currently in one of the members' name, or if running an SMSF by yourself in your own name? Look, it needs to be for the sole purpose of providing income for retirement, and it needs to be an arm's length transaction. So you cannot buy a residential property off one of the members. There is an exemption to the rule, is if it is a commercial property. If it's a commercial property, you can buy it off your business or you as an individual, but a residential property you cannot. How much do you have to have in super to establish an SMSF? Well, there is no rule of thumb. With the mini SMSF, you probably need a combined superannuation balance of 50 grand. So if you and your wife have 25 grand in it each, you're at 50 grand, which is suitable for the mini SMSF. What you're going to need to do, and the investment manager can help you with this, is do a cost-benefit analysis for your specific superannuation entity to see what fees you're being charged, so you can make an informed investment decision as to which one can serve you over the long term. If you pay land tax on a property, what do you pay on a unit? Marge, good question. On your land tax, the tax notice, they're deemed a land component for a unit as well. So for a unit, every year when you get the land tax coming through, there's a deemed land component on it, and that's what's subject to land tax above the thresholds. Units, villas, and townhouses just as viable in an SMSF? That's a good question. I think units and townhouses are good because they provide high rental income. Generally, more rent you can earn on a unit or a townhouse than you can for a house, for instance. However, by what I understand about property, though, is the capital growth comes about through property. So generally houses attract higher capital growth, where rent and townhouses offer a higher yield. Townhouses are probably a mixture of both because it does involve greater land component than a unit, but also you are able to gain a higher rent, generally speaking, because of the high density nature of the properties. Is P&I more advantageous over interest only? Look, there's risks and benefits of both. P&I or interest only can be beneficial, provided you're doing something with the cash flow savings. If you went out and spend it, obviously that's not a good strategy. Principal and interest would be better off than just going out and spending it at a David Jones or online. If you can get the money into a vehicle working hard for you, though, for Peter and Ann, they need to achieve around 3.6% return inside of superannuation to ensure those contributions that they're putting into super is going to accumulate to more than 450 grand to pay off that loan. So for Peter and Ann, if they think they can achieve a return greater than 3.6% per annum, then converting to interest only and putting the cash flow savings into super is a better strategy. But it's specific on your individual circumstances. Is the personal finance criteria the same for an SMSF as borrowing outside of an SMS? No. A self-managed super fund, it's a lot easier to gain a loan because obviously you don't have personal expenses coming out of it. The expenses are generally known up front, being the ongoing administration fees, all that sort of stuff. So it's generally a lot easier to gain a loan in an SMSF, provided you have all the information provided. Now that's what we organise. Because we do the accounting and the administration work, we just hand over to the bank all of your super statements. So it's all in one pile. Like there's good debt, bad debt, and I think phenomenal debt that exists for self-managed super funds. Obviously in your own name, you've got expenses that can go up or can go down, so the banks consider a buffer and take into consideration those expenses, which can be a lot higher than inside a self-managed super fund. Can you set up the SMSF and then not activate it until you find the right property? What you can do is set up a self-managed super fund, roll over your existing superannuation and put it into cash, and just leave it in cash until you find a suitable property to go fund the purchase. So definitely, the earlier you start looking at interacting that process, the greater chances you have. Because to set up a self-managed super fund, to do the rollover, it's probably going to take 6 or 7 weeks, 2 or 3 months. So don't just wait to find a property today and then go, okay, I'm going to go set up a self-managed super fund, because you're not going to be in the capacity to buy that property for another 2 or 3 months, which probably means you're going to miss out on that property. So it's important you get the wheels in motion straight away if you think that this is suitable. Should you leave your money in the super fund it is in? If not, how would you achieve growth in the SMSF until the property is purchased? So you can leave it in cash. Look, there's other alternatives by short-term term deposits that can provide a higher return than cash. Obviously, it's not a call, but you've got all the flexibility to invest inside a superannuation as you do outside of it, provided for the sole purpose of providing income for retirement. So it doesn't necessarily need to be in an out-of-call bank account. You can have it tied up in something that's providing a little bit more of a return, but still got access to it. Could you buy a Defence Force property within SMSF where you're guaranteed rent for a long agreed term? Look, I had a conversation about these Defence Force properties actually today by Michael Roberts, our legal expert, and he was considering them. While they offer rent, they don't offer high capital growth potential, and generally the bank will only lend up to 50% to fund the purchase. So because of that, he thought that it's not always an ideal situation to go out and buy Defence Force houses in their self-managed super fund. So it depends. But yeah, there's obviously pros and cons of doing both. Does a government contribution to super only apply to people that are employed, or can you get it from income off investments only and contribute $1,000 in your personal name? Yeah, so you can gain the benefit of the government co-contribution. You don't need to be working. You put $1,000 in after-tax dollars. The government will match it. What is the maximum LVR banks offer with self-managed super fund? For residential property, it's 80%. For commercial, it is 70%. Phone number, excellent. Good work. One-on-one meeting, books, etc. Good work. Yeah, excellent. How to register my name? Just insert your details into this section. I think that's the easiest way. I'm not tech savvy. If you put it into the questions, I know how to extract that so we can pass it on to the people in your state. Thanks, Justin. This would have to be one of the best informative webinars I've attended. My husband and I do currently have SMSF, which is not being utilised efficiently. Now, if you already have a self-managed super fund, by all means, you're well and truly on your way to be able to achieve some of these strategies being utilised. There's a statistic that just came out that 40% of self-managed super funds that are established are sitting in cash. Now, the cash rate, you look at after the RBA dropped interest rates yesterday to 3%, are at almost all-time lows. Many people are looking at growth assets simply because they can't get a return in their in any bank account. All of our funds sitting in the bank account in the SMSF. We currently have 2 investment properties in our own name plus our residential home. We've been contemplating selling some of these assets. I would welcome the opportunity to talk to yourself or a representative regarding investment opportunities. Excellent. Kerry, we'll get in contact with you over the next few days to organise that one-on-one meeting. Yeah, Making Super Sexy book. We'll send you an e-copy of it straight away. Not ready to do anything, just want the DVD. Yeah, that's fine. Look, we'll send the stuff from Budgewoi. I grew up in Terrigal, so close by on the Central Coast. So look, we can send you a copy of the DVD as well as the ebook to get you started. But again, if we do a super review for you, we'll do that for nothing. We can look for lost supers. So this is all a part of the super health check. You may be surprised in that you might have enough to set up a self-managed super fund. At least we can give you that information. Thanks for reading my questions. No dramas. All good. So look, by all means, look, thanks for joining in tonight. Look, I made you a commitment at the start was to give you a few golden nuggets. As you can see, it's pretty technical stuff. There's a lot of information that I've inundated you with tonight. It's important to seek advice in this space, because if you attempt to go it alone, the cost can be huge. For instance, to give you an idea of some of the common mistakes that we see, is that if you set up a self-managed super fund, many people go to an accountant and set up a self-managed super fund, they then go to an auction and they think, you know what, I've got 300 grand in my super fund, it's only worth 450 grand, I'll be able to borrow the extra 150. it's less than a 50% LVR, and they go buy it. And that day at the auction, it exchanges as soon as the hammer goes down. You put in the details to buy that property in the self-managed super fund's name. Well, you've got a bit of a problem. You got a problem because if you have to borrow in it, it's in the wrong entity. If it's in the self-managed super fund's name, it needs to be transferred out into the Bear Trust. To transfer it out after exchange means you're going to incur double stamp duty. In Queensland, if the deed isn't constructed in the right way initially, once you pay off the home, it gets transferred out of the Bear Trust into the self-managed super fund. So when you transfer it out, if it's not structured the right way up front, you can in fact be charged 3 times stamp duty. Now that's very expensive. Stamp duty is pretty high across the country. It's a huge amount that you want to avoid at all costs. If you have the right advice up front, you can avoid those extra stamp duties that you don't need to pay. So there's a few simple mistakes that you can make that can easily be avoided if you're doing it the right way. And that's what our job is to do, is to hold your hand. If you look at the fees that we're charging for the ongoing mentoring program, for the one-on-one consultation with SMSF and that hand-holding process through the entire time, an act called property expert, finance expert, legal expert, we're ensuring that you're going to make the best investment decisions you can and have all the information to make an informed investment decision to maximize your retirement income. So again, thanks very much for tuning in. I'm glad you enjoyed it, and hopefully you've taken a few nuggets. Again, look, happy investing, and the early start taking super seriously, the sexier it's going to become. Hopefully tonight I too have turned you on with super. Thank you.